Is the US dollar losing its grip on global power? In 2025, it plunged dramatically, the steepest drop in decades. Rising debt, political turmoil, and digital currencies are challenging its dominance. Could this be the end of the dollar's era as the world's most powerful currency? Chapter 1. The 2025 dollar decline and market shock. The year 2025 has been a roller coaster for the US dollar. After more than a decade of strength, the dollar has fallen roughly 7.5% against major currencies so far this year. That's a huge move in currency markets, especially considering the dollar's usual role as a haven during global uncertainty. But this time, things are different. In early April, when the Trump administration announced sweeping new tariffs on dozens of countries, the markets didn't rally behind the dollar as expected. Instead, the dollar dropped sharply. Normally, during market turmoil, investors flock to the dollar for safety. Yet, in 2025, the opposite happened. Why? It's because investors are worried, not just about tariffs, but about the overall resilience of the US economy. The tariffs raised fears of a global trade slowdown, and investors started questioning the safety of US assets. Add to that concerns about inflation rising due to those tariffs, and confidence began to erode. Rating agencies like Moody's even downgraded the US credit rating recently, shaking confidence further. This combination of trade tensions, inflation fears, and fiscal concerns triggered a sell-off in the dollar, marking its worst start to a year since 1995. The dollar's decline isn't just a reaction to one event. It's the result of a growing unease about America's economic leadership and policy direction. Chapter 2. Federal Reserve Interest Rate Shifts. One of the biggest factors behind the dollar's slide is the Federal Reserve's changing approach to interest rates. In 2024, the Fed kept rates relatively high to fight inflation, which helped support the dollar by attracting foreign investors seeking better returns. But in 2025, inflation has started to ease, and the Fed signaled a pause and even hinted at possible rate cuts later this year. Lower interest rates mean lower returns for investors holding dollar-denominated assets. As a result, foreign investors have become less eager to buy US bonds and other assets, reducing demand for the dollar. This shift is significant because interest rate differentials are a major driver of currency values. When US rates were higher than those in Europe or Japan, the dollar benefited. Now, with the Fed easing, other currencies look more attractive. This has accelerated the dollar's decline. The Fed's policy decisions are closely watched worldwide, and their impact on the dollar is immediate. The prospect of lower rates has made investors rethink their portfolios, pushing capital toward other currencies with higher yields or perceived stability. Chapter 3. Rising US debt and fiscal concerns. Another major concern weighing on the dollar is America's soaring national debt. In 2025, the US national debt will have surpassed $35 trillion, a staggering figure that continues to grow. With government deficits ballooning and interest payments on that debt rising, questions about fiscal sustainability are intensifying. Investors worry that the government's borrowing needs could lead to higher inflation or force the Federal Reserve to keep rates elevated longer than planned. Both scenarios create uncertainty, which is bad for the dollar's value. Moreover, Moody's recent downgrade of US creditworthiness highlights these fiscal risks. When a country's credit rating falls, borrowing costs tend to rise, and confidence in its currency can weaken. This growing debt burden challenges the dollar's exorbitant privilege, the unique ability to borrow cheaply and attract global capital. If investors start doubting the US government's fiscal discipline, demand for treasury bonds could fall, further pressuring the dollar. Chapter 4. Accelerated global de-dollarization. The final piece of the puzzle is the accelerating trend of global de-dollarization. For decades, the US dollar has been the dominant reserve currency held by central banks worldwide. But in recent years, especially in 2025, this dominance is being questioned. According to the International Monetary Fund, the dollar's share of global foreign exchange reserves has dropped below 58%, the lowest level over 20 years. Central banks in Europe, Asia, and the Middle East are diversifying their reserves into euros, yuan, gold, and other assets. This shift is driven by multiple factors: geopolitical tensions, trade disputes, and a desire to reduce dependence on the dollar amid US policy unpredictability. Countries want to protect themselves from potential sanctions or dollar volatility. The trend is also reflected in global bond markets. Issuance of US dollar-denominated debt by non-US governments has fallen sharply in 2025, signaling less reliance on the greenback for funding. Chapter 5. Political instability and eroding investor confidence. Now, let's start with the political storm brewing in the United States. 2025 has been marked by intense political polarization in the United States. Congressional gridlock has delayed crucial budget decisions, including debates over debt ceilings and fiscal reforms. This deadlock creates uncertainty that ripples through financial markets. Investors hate uncertainty, and when Washington struggles to agree on basic economic policies, confidence in U.S. assets weakens. This political instability isn't just about delayed budgets. It affects regulatory policies, trade negotiations, and even the independence of the Federal Reserve. Many investors fear political pressure could influence interest rate decisions, undermining the Fed's credibility. When the central bank's independence is questioned, foreign investors become cautious about holding dollar assets. The result? Capital is flowing out of U.S. markets and into currencies perceived as more stable, like the euro and Swiss franc. This shift is eroding the dollar's safe haven status, a key pillar of its global dominance. Chapter 6. Strengthening competitors and global economic rebalancing. While the U.S. faces these political and fiscal challenges, other economies are stepping up. The Eurozone, despite its hurdles, is seeing increased capital inflows as investors diversify away from the dollar. The euro has strengthened by about 5% against the dollar in 2025, signaling growing confidence. China's yuan is also gaining ground, supported by gradual financial liberalization and expanding trade partnerships. Although capital controls limit the yuan's full potential as a reserve currency, China's economic size and influence make it a serious contender. Emerging markets, especially in Asia and the Middle East, are also attracting investment to reduce reliance on the dollar. Countries are issuing debt in their currencies or euros rather than dollars, further diminishing dollar demand. This global economic rebalancing is a slow but steady process. It doesn't mean the dollar will disappear overnight, but the era of uncontested U.S. currency dominance is being challenged by a more multipolar world. Chapter 7. The rise of digital and central bank digital currencies. Let's explore one of the most disruptive forces reshaping global finance: digital currencies. Central bank digital currencies, or CBDCs, are being developed and launched by countries worldwide. China's digital yuan and the European Central Bank's digital euro are leaders in this space. CBDCs offer faster, cheaper, and more transparent cross-border payments without relying on traditional dollar-based systems. This innovation reduces the need for intermediaries and chips away at the dollar's central role in international trade and finance. Cryptocurrencies and blockchain technology also provide alternatives to the dollar's dominance, especially for countries seeking to bypass U.S. sanctions or reduce exposure to dollar volatility. However, cryptocurrencies remain volatile and less widely accepted for now, but their underlying technology is influencing global finance profoundly. The United States has been slower to adopt a digital dollar, but the rise of these technologies is undeniable. Over the next decade, digital currencies could significantly weaken the dollar's grip on global finance. Chapter 8. Stability, volatility, or transition. So, what lies ahead for the US dollar? Even with its recent decline, the dollar remains the world's primary reserve currency and a cornerstone of global finance. Experts agree that no immediate replacement is on the horizon, given the Eurozone's fragmentation and China's capital controls. However, the dollar's dominance is no longer guaranteed. The combination of political instability, rising debt, global diversification, and technological disruption means the future will likely feature more volatility and competition. Medium-term forecasts from leading financial institutions suggest the dollar could weaken another 10 to 20% against major currencies like the euro and Japanese yen over the next decade. This would represent a significant unwinding of the dollar's long-term overvaluation. Still, the dollar's deep liquidity, established financial markets, and network effects provide strong support. It is more likely that the world will move toward a multipolar currency system, where the dollar remains dominant but shares space with the euro, yuan, and digital currencies. The US dollar's future in 2025 faces both support and pressure. Early strength from economic growth and interest rates contrasts with rising debt, political uncertainty, and global diversification away from the dollar. Meanwhile, digital currencies are reshaping finance, challenging the dollar's dominance in a more volatile, multipolar world. Interested in staying ahead of global market shifts? Hit subscribe and join us for your next deep dive into the world of finance. Have a take on the future of the US dollar? Share it in the comments below. Thanks for watching.